We are just going to go ahead and kick it off. And so I just wanted to say welcome to the Homebuyer Series with the Theriault-Fazio team at Proper Rate. My name is Joanne Theriault-Fazio, and I'm the SVP of Mortgage Lending and Branch Manager here at Proper Rate. And I'm thrilled to be one of your hosts for today's session. Sam Fazio, SVP of Mortgage Lending, is also joining me as a co-host, and you will hear his voice. You just may not see him on screen today as part of the technical difficulty. But before we dive into today's topic, we wanted to quickly introduce ourselves and our team for those who may be joining us for the first time in our webinar series. As a husband and wife duo based in the Chicagoland area, we are personally licensed in 18 states. Making our expertise widespread, we have been in the mortgage real estate industry for multiple decades at this point and have had the privilege to assist thousands of borrowers. Our team is very well versed in the mortgage process and has been with us for a very long time and some of the best and brightest in our industry. And we personally have been with Guaranteed Rate Companies for over 15 years. And in 2020, we launched our sister company, Proper Rate. And we're backed by one of the top lenders in the country with the absolute best and most consumer-friendly platform. We are excited to provide some expert guidance on a crucial aspect of the home buying process in life, whether you're a realtor or attorney, helping a home buyer through the complexities of this market, or a home buyer seeking essential information on mortgages. We have you covered. And our aim is to equip you with the knowledge and tools necessary to navigate this ever evolving market, putting you one step closer to your dream home. Our goal today is to make the home financing process as seamless as possible, and we take pride in being knowledgeable and accessible to our clients, and we're excited to share our expertise with you. So let's get started on today's topic. We are going to be talking about first-time homebuyer programs, and surprisingly, some of these programs that we're talking about are definitely more geared towards first-time homebuyer programs. But if you are not a first-time homebuyer or have a client who's not a first-time homebuyer, they still may be able to take advantage of some of them. Anyway, feel free to drop some questions in the chat box and we will try to get to as many as we can, but most likely won't be able to answer them until after the call because we have a lot to cover today. And we're definitely more than happy to, talk with you on more specifics after the call as well. So just feel free to reach out to us if you have any questions. So let's dive in. We're going to talk about first-time homebuyer programs. Down payment assistance. We're going to just touch on our Power Bid pre-approval, which if you've been on any of these calls with us before, we've definitely covered that in the past. And we'll just touch on the next seminar or webinar that we're doing, and then also the gift card winners at the end as well. Information about our team, which you can find on our website, our link tree, any of our social channels. Feel free to check them out and follow us. Just real quick, before I turn the next slide with some of the more nitty gritty of the programs over to Sam, just want to point out some things. If you're here today, maybe you have people who are renting as clients. Maybe you yourself are a renter. And one thing I always find that's kind of a staggering number is what people will pay in rent on somebody else's mortgage over a time frame. Obviously, and I'll just kind of circle around this number. If you're staying in your same place for 30 years for $4,000 a month, that number is pretty staggering. But even if you are only paying, let's just say $2,400 a month, and you are renting for 10 years, I mean, that's almost $300,000 in rent. You're not writing off any interest, real estate taxes. You are not gaining any appreciation in value or paying down an asset or anything like that. So just some interesting numbers to be aware of if you are currently a renter and you're thinking that you really do want to take the next step in home ownership. So we're just going to really dive in. This is not to make you an expert on these programs. This is not so that you can go out and, talk mortgages at a high level. This is just some real basic information to give you an idea on whether or not you can qualify, if this is a program you can take to your clients. But we have a lot of programs that are first-time home buyer. We have a lot of programs that are geared towards low to moderate income. We have a lot of programs that are down payment assistance related, and excited to, kind of dive in and share those with you. So I'm going to turn it over to Sam to talk about our, just like our affordable product comparison chart.
Good afternoon. I'm Sam Fazio, Senior Vice President of Lending with Proper Rate. And as Joanne said, yeah, first-time homebuyer products right now are really coming into play, and a lot of reasons there. You're actually getting better rates than a lot of the other buyers that are out there right now. So you can take advantage of a couple of things here where you can have the lower down payment, lower credit score, and still take advantage of lower interest rates. So when I'm talking about the lower interest rates right now, in our industry, if you look at the bottom of this slide, there's something on there that says LLPA, which actually just stands for loan level price adjustments. If you are not a first time home buyer, or don't qualify with the income levels, you're going to be subject to all of those loan level price adjustments. Just to kind of put this in perspective, to what this means to you as a first time home buyer, whether you fall into the lower or the 80% adjusted median income or the 100% adjusted median income, it's a huge difference in interest rates. Again, put it in perspective, I was looking at yesterday someone with a 660 credit score, got them locked in at 6.475. They were only putting down 3%. Someone who was putting down 20% with a 716 credit score was actually at 7.5. So you can see there's a huge difference there. And that's why that first time home buyer market right now is kind of booming, because you are getting better interest rates. So it keeps the affordability down for you in that scenario.
Right. And then also, if you look at this little chart, we love to abbreviate when it comes to mortgage lending. So, if any of you've been on any of our past calls, you probably have heard us use LTV, which is loan to value, FICO, your credit score, and different things like that. You could probably even see us abbreviate first time home buyer as well, FTHB, all the time. We love to abbreviate things. So, with that being said, what's kind of cool about this chart is that, it tells you a couple of things like, is there even a first time homebuyer requirement? No, yes, yes, no. So we have some programs when we're looking at the area median income, like we'll go to 100% of the area median income in a lot of circumstances. So just for example, in Illinois, that number is $109,400. So when we're looking at Illinois, we can go to 100% with the first time home buyer. When we have somebody where we're trying to see if we can get a little bit better of an interest rate, or they qualify for a special program, they need to be at 80% of that number. So there's a lot of factors that go into it. These particular programs are all conventional programs. They're government backed by Fannie Mae and Freddie Mac. So we're going to, have to adhere to their guidelines and everything. But sometimes we'll have an easier time getting somebody approved on this AMI program than say somebody whose income is higher, or they're very bonus heavy income and they're only putting down 5%, but they don't fit into this bucket. The landscape of lending has changed a lot in the last couple of years. What's really cool about right now is we're actually getting more products at proper rate instead of retracting, which a lot of lenders are doing. So we do have access to a lot of these great products as well. Sam, do you want to touch on the homebuyer education component too, because it is required sometimes for the
Yeah,
programs?
so when we're talking about homebuyer education, it's really just an online class that's going to be required. We would be able to send you the link to go on to the Freddie Mac or Fannie Mae direct website, and it's just going to give you kind of a brief overview of managing your budget, and then what to expect as far as being a first time home buyer. Talk about making your payments on time, and if you don't, how that'll affect your credit. Really, it's kind of just something that is a requirement, but is not really all that time consuming. I think most of our clients are getting it done within like 10 minutes,
Mm-hmm.
for the most part. So you don't have to go anywhere. It's all done online.
Right. Yeah. Pretty seamless process. These used to have to be done in person. So a lot's changed in the last couple of years. So we're really trying to streamline a lot of the process. But just real quick, wanted to touch base. I know we have people on here from all across the country. And so we just kind of took polar opposites when we were looking at that area median income number. So if you are either a first time home buyer, or have a client who is a first time home buyer and you're like, oh, I don't know if they'll fit into this bucket. We can look it up in any county. Every county is going to be a little different. They call it an MSA, like the metropolitan area. So it just really depends where they are. Like, the number for, say, Burlington, Wisconsin is significantly lower than Chicago, Illinois. But if you look at this little chart that we pulled, the number for like the San Francisco, California area is like almost, actually, I think it is double in some cases, like the Tampa, Florida area. So it's really going to vary for these particular programs. And it's really important that, like, if you think you're going to be getting a raise, or if you have a spouse that maybe their income puts you over the threshold, we can look at this number and say, well, we actually don't need the spouse's income on this. So maybe we remove them from the mortgage or just don't use their income, which we can do, and they're just on title or something like that. So we're able to get really creative when we're doing this too. We don't have to use all bonus income when we're qualifying. It's like it's an all or nothing thing. So we have to use the salary, but if you also get bonus and commission, I can use one or the other or none of those. So just because you are over this number doesn't necessarily mean that you won't qualify for the program. We just kind of look at the overall picture of your file and everything that you submit. Sometimes it's why we might ask for some pay stubs and get some information up front other than just, take somebody's word at it. And if you're self-employed too, you can also qualify for this. Self-employed borrowers have a tendency to write off quite a bit. And so sometimes we'll end up showing on their tax returns that they make a lot less money than what maybe their affordability in their minds would afford them to. So it's one thing to consider too. You don't have to be a W-2 borrower to qualify for this program. But what I just kind of thought was interesting about this is just like, you can just see that like you've got one end of the country to the other, and it's just very different on what qualifies for that area median income. So this next chart, a whole bunch of numbers that I'm going to let Sam touch on. And like, he kind of gave you an example already about differences in rates in some of the programs, but I'm going to have him dive into these two different scenarios that talk about the difference in programs and like the loan amount affordability too. Sam, I think you might be muted.
No, I'm here. Sorry.
Okay.
Just hard for me to see without having it like in front of my thing, so I apologize.
Put your readers on.
I'm sorry, what was that?
I said put your readers on.
Right, I did that. So what we're looking at, if we're looking at affordability, and we're talking about the differences in the two areas, or however that's going to work out, the process is the same. It's just the numbers that are going to be different. Okay, so when we're looking at like our 100% loan to value scenario, it does allow you to can use more qualifying income versus the lower income. And in that scenario, like I said, we're always just going to kind of double check to make sure we're only using that qualifying income to make it work for you guys, right? Is basically how we're going to look at it.
Right. And then we've got some payment differentials here too. So just like your regular 30-year fixed with, you can go to 3% down on it with the rate being higher versus the first time home buyer. So everything's like outlined in red here. The first time home buyer program. This scenario is only showing a half a point difference. Like rates, I mean, we can get pricing adjustments multiple times a day. They fluctuate. The market's definitely still volatile when it comes to rate movement, and it's really just going to be very heavily driven on loan to value, credit score, all of that. But Sam's scenario is probably a little bit closer to what reality is today versus I think we put this chart together a couple of weeks ago. So even just showing 0.5%, you can see what the difference is in terms of the price point. So we're going to dive into down payment assistance. Those programs all are just regular, fixed rate mortgages backed by Fannie Mae and Freddie Mac in the secondary market. But there are a lot of other programs out there for first time home buyers. Some being down payment assistance. So, Sam, you want to dive into a little bit about like what down payment assistance is, and then I can go into some of the more specifics on them.
Yeah. So in the scenario where you've got down payment assistance, there's a couple of different options and different entities that provide down payment assistance. One, I'll use Illinois here as because it's the state that I'm in as kind of the example. What we have here in Illinois is there's a program from the Illinois Housing Development Authority. It allows you to get anywhere between $6,000 to $20,000 to be used towards the down payment. And what we would do is we would determine which one kind of works best for you. Now, some of the programs are what are called forgivable, and some you do have to repay. So the difference there is on a forgivable loan, that we'll use the $6,000 for example, is forgiven at $50 a month over a 10-year period. Okay, so if you stay in the house for 10 years or you don't refinance, that $6,000 just kind of goes away. If you were to refinance or sell your house within a 5-year period, then you would have to pay back $3,000 of that money at closing. So the benefits to any buyer when utilizing these programs is you're not using all of your cash. They are going to require at least 1% of your own funds for the down payment. So you're not using any of your own cash. And a lot of times right now they are below market interest rates, depending on what's going on in the market. And they don't fluctuate as much on the rates on these because they kind of go off of a set number of when the money was put into a pool. And it doesn't change until all that money from the pool runs out. So there's definitely a longer term lock on rates when we go to that, or at least, less fluctuation on rates in those programs. And they work exactly like any other loan. So we just have to qualify you and make sure that you meet all the guidelines. The only difference really, anytime we're doing a down payment assistance program, credit score is always going to come into a factor, and they're strict on what we would call your debt to income ratio. So you cannot exceed a 45% debt to income ratio, and your score needs to be at least a 640 or higher in order to qualify for that. Again, that's the state programs. There are a couple of non-state programs that do allow you to get the down payment assistance, and they do have some flexibility on credit scores and the debt to income ratio, but they come with a higher interest rate. So there are some differences in there. We're always going to try and utilize a state bond program before we utilize a non-state bond program. And, just because you've got better options in that scenario with the state ones.
Mm-hmm. Yeah, we kind of look at all the options really just depending upon one, comfort level, what somebody wants to spend on a monthly basis. And I think also based on just how much you have of, your own funds to put down in the bank, and how much flexibility we need with like the debt to income ratio. The debt to income ratio seems to be a huge driving force right now in a lot of loans. And sometimes it's just because we are only including one person on a loan for various reasons, whether it's the other person has a lot of student loan debt, or is currently out of work, or has a job gap or something like that in their history. So Sam specifically called out the IDA program for Illinois. There are programs across the country that we can introduce people to. Like, for example, the Indianapolis Housing Authority has an area median income of $114,200. There's a California Dream program that gives you 20% of the purchase price or the value if it happens to be lower, but that's for the low income. Now, some of these programs, the funds, like Sam mentioned, they'll dry up faster than others, and so it's always important to check to make sure that there's availability. There's low inventory kind of across the country. So if you're not finding a home immediately and you're kind of, set on doing, say, the IDA program, like, it's always good for us to have a backup in case funds run out of one of the programs at any point in time. But we have one more program to go over really quick. And as I'm pulling this information, Chris is going to go ahead. He did a spinny wheel, and he's going to go ahead and pop the winners of the gift cards in the chat. So he'll start with the Target gift card, and then the next 10 will be the Starbucks gift card winners. And then everybody will get individual confirmation as well if to get their gift cards. But thanks for joining us. And just really quick, I want to talk about one more program that we have that's nationwide, that we've had for a really long time. And I think its popularity kind of just ebbs and flows based on demand for the program. But we have the Chenoa Fund down payment assistance program. This one actually lets us go up to 135% of area median income for any given area that we're lending in. So it really does help with, say, somewhere like I mentioned, Burlington, Wisconsin, where the number might be a little bit lower. You actually don't need to be a first-time home buyer on this one, but you can't currently own a home. So if you have a home that you're selling and you need, say, you're just not netting what you wanted to and you need some assistance on the new one, we can definitely do that, but you have to have that existing home closed and sold beforehand. There is a minimum LTV of 90%. So if you're like, oh, I really like the idea of this program, and the rate's comparable to what I would get on just a regular 30-year fixed, but I want to put down 20%, you can't do that. You can't put more than 10% down on the program. It's structured where it's like a second lien. So what kind of like what Sam was talking about with the other program, you can get anywhere from 3.5% to 5% for down payment assistance. And there's two options. There's the forgivable 30-year, which is like, that's a long time to keep the same mortgage, where that's at 0% and it's forgiven after 30 years. If you refinance or sell before then, you're paying back a portion of the down payment assistance. Or there's the more popular one, the repayable 10-year. So basically, the way they look at that is they take your first mortgage and they add 2% to the rate, and that's how you're calculating that second mortgage down payment assistance. So say you only need $5,000, and I'm just using very round numbers here. So say it's your first mortgage is at 7% and we've got add 2% to it, so 5,000 at 9% equates to about $64 a month. So a very small amount to be able to get some extra funds, but it's a program that we're probably going to see more of just given current environment and everything. So we are coming up on 3 o'clock. These half-hour sessions go so fast, and we threw a lot of information at you. So just a few things to recap. If you have questions, just reach out to us. We're happy to answer questions no matter what market you're in. If for some reason it's not a state in which we're licensed, we're happy to refer you to somebody that is licensed there, that we trust, that can take care of you. But we are licensed in 18 states, so chances are we're probably going to be where you need to be. Also wanted to mention that we kind of talk about this, I think, at the end of every presentation, just that we still think that the best thing to do in this market is to get a fully underwritten pre-approval. So we will issue a pre-approval based on the information provided in an online application. We love to upgrade it into our power bid approval, just so that you have just like a step above any competition on any given house that you might be trying to make an offer on. So just wanted to put that out there too. We can also do full pre-approvals on our bond programs too, on our first time homebuyer programs, on our AMI programs, anything. So that's really important. We will send out some steps to the process of buying your first home, or any home rather, not just your first home. And then our next session is actually coming up pretty quickly. August 9th, we're going to be talking about removing contingencies. So that means removing a home sale contingency, what it takes to do that, and also to remove a mortgage contingency, which is a little bit more complicated, but it also involves that power bid pre-approval. And then if you happen to be a real estate or agent or an attorney on this, I am hosting a call for Grow Guaranteed Rate Organization of Women for condos on August 3rd. Feel free to reach out to us if you'd like more information on that. And that is 1 minute to spare, and Chris is going to drop everybody in there.
I would like to just add one thing. Right now, I mean, I've been in this business now for 22 years, and ever since there was first-time homebuyer programs versus like your normal second-time home buyers with conventional financing, never have the rates been more advantageous to a first-time home buyer than they are right now, versus someone who has been a homeowner and putting down a bigger down payment. So the rates are still higher, obviously, than where they were like 2 or 3 years ago, but you are getting better interest rates now than you would if you were a second-time home buyer or a move-up buyer. Like I said, that difference in rates between what they're getting versus what a first-time home buyer is getting has never been greater. So if you're in that market, it may be time to take advantage of it. And, you're getting in where housing prices are still at a decent level. And if we get to a point where interest rates ever drop, you can take advantage of that and lower your overall payment as well.
Very good point. I'm glad that you added that because that is also a big part of the cycle of owning a home as well. Okay, so those numbers mean they're the numbers in which people registered. So we will get that out to everybody for the gift card winners, and we'll list them in the email follow up that we send everyone. Feel free to check out our link tree. We have a lot of events locally in different markets in different states, and of course these virtual events too. We're also running a really fun promotion right now on our social media. If you check it out on our app, you can download our app to your phone and win like this huge, amazing package prize that our team put together with a whole bunch of good stuff in it for summertime. So feel free to share it with friends, get you extra entries and all that. But go ahead and check that all out. And thank you everyone for coming and showing up today. Appreciate it.
Thank you.